Hello, everyone. Welcome to today's Prime Talk, a discussion forum from ET Prime. My name is Sidhartha Shukla, and I'll be your host for this evening. I write about the capital market and cryptocurrencies for ET Prime. Along with me, our markets editor, Pravin Palande, will be co moderating this panel. It can't be a better day to have this discussion as the market has scaled to new all time highs and the Nifty index breached levels above 17,100. So, where do we go from here? Is this the market top, or does this rally have more steam left? To discuss how one should hedge their bets and protect their investments from both downside as well as upside risk, we have with us three well known market experts joining us today. First, we have Savi Jain, co founder of PMS firm 2.2 Capital. Then we have Vikaas Sachdeva, CEO, Emkay Investment Managers. And lastly, we have Nitin Bhasin, co head, Institutional Equities and Head of Research at Ambit. Hello, Savi, Nitin, and
Hi,
Vikas. Thank you for joining us today.
hi Siddharth.
So, before we start the conversation, a few housekeeping points for everyone who has logged in. We have kept the final 15 minutes to answer questions we had received from our members at the time of registration. Also, a quick disclaimer: the views expressed by the panelists and host on various topics should not be construed as investment advice. On that note, let's begin the discussion. So, my first question is for all three of you. The market is at a new high again, and no one knows where it's the top this time or not. How important is asset allocation in such a scenario? And what should be the strategy for portfolio diversification in order to manage both upside and downside risk at current levels? So, Savi, would you like to start?
Sure, Siddharth. Yeah, I mean, see, asset allocation is always important, irrespective of where the market is. And, obviously, when the markets are at an all time high, it becomes especially important. But I think broadly, an investor should stick to strategic allocation targets. Everyone has a target that I need to have, say, 60% in equities and say 30% in debt, 10% in gold, whatever that number is. But as one asset class goes up disproportionately higher or lower, there is obviously a deviation from that target, and I don't think a slight deviation should result in someone trying to reallocate or rebalance the assets, but a significant deviation. For a significant deviation, I think there should be some kind of rebalancing. And there are two ways to rebalance. One is obviously you sell one of the asset classes which has become very high in allocation, and the second obviously is that incrementally you stop allocating to that asset. So either ways, I guess, as long as you're sticking to a strategic asset allocation and not taking knee-jerk reactions based on the narratives that are around, I think that should be sufficient.
you know, uh, could not disagree with whatever Savi said. But as Siddharth and to all the participants, asset allocation can become very individual specific in terms of their ability to tolerate risk. So one of the key determinants of asset allocation should be not only having debt and equity with the mindset of long, but also availability of some cash with you at any point in time, given opportunities arise, which are very exciting in terms of pricing and the risk that they offer. Hence, asset allocation should also be considered in the light of risk management.
Sure. Nitin. Vikas, same question for you as well. But let me add something to that as well. Like Savi said, if one asset disproportionately goes up or goes down, then you can probably book some profits over there. So, what are some of the instruments where people can park their money or wait till the time there's a correction?
Well, actually, if you're talking about asset allocation, this question is self-answered. But let me just pick up a few points from my co-panelists and add one of my own. I think the three key tenets of asset allocation. Obviously, the first one is you have to talk to an advisor or you have to be comfortable with the asset allocation you have gone in for. The three key tenets, and not necessarily in that order. One is regular monitoring. So that could take care of any sharp upsides and downsides which might happen. Discipline, which means that at any given point of time, if there are signals coming about for you to do an asset allocation, you should do it rather than getting emotionally invested in a particular asset class. And the third thing is quality. What I mean by quality is very often I've seen a lot of investors, even if they are doing proper asset allocation, for example, if they're in fixed income, they tend to try to juice out that particular asset class. How much more can I get from debt? And that at times leads to wrong decisions. You might want to get into a credit risk fund without realizing what it means. Now, if you do that, then at times it is going to, lead to a situation which Nitin just mentioned, that when you need cash, you may not have cash. You will have an asset allocation in debt, but when you want to liquidate that debt, you may not be able to do it at the right price. So I think the three key tenets are basically discipline, monitoring, and quality, not necessarily in that order. And where people can park in their money till the time they are in transit. For example, if they want to shift their asset classes, I think there are some very safe options. It can be some very high quality bank fixed deposits. It can be liquid funds. It can be arbitrage funds. I think safety is a little underrated at times when it comes to all of these instruments, but that is the bulwark which these instruments offer you.
Sure. All right.
Okay.
Yeah, Pravin, go ahead.
Yeah. So Nitin said that cash actually is actually a part of your diversification, right, Nitin? Like, the way. Okay. I just want to understand, like, the ratio of cash, like, would you have some kind of metrics to look at it in terms of where the equity markets are? How would you look at it? Like, if you have to do some ballpark kind of, so you remember that, there was this, there is this very weird calculation we go by, like, 100 minus age, your age is basically in equities or whatever, right? Remember? So if I'm 25 years old, 100 minus 25, that means 75 should be in 75% of my assets should be in equities. Now, when you're talking about cash precisely, do you have some kind of, like, some basic idea where, like, people say, like, oh, the market is here, this much cash I should have, like, I mean, if you're given it a thought, or if you would like to kind of talk about it.
I wish could come up with some sort of a formula for making it simpler, but it's just the experience of reading investors and perhaps also looking at asset managers, for some of them who have taken a very contrarian call of going into cash at certain levels of the market. But I would say no perfect answer, but given how much you can manage your emotions of holding on to cash and missing them. That. So today, it could be a number very different as compared to what it was perhaps 1 year back or 1.5 years back. Exactly. Imagine if anybody was sitting without cash before the COVID crash. They were just watching the market go down.
One more question that comes to my mind is gold, like, the allocation towards gold. Like, throughout this entire rise, okay, gold is something that people have started to talk about. How seriously should we take gold now? Because it has an inverse correlation to the equities, or at least the long-term correlation.
So I would let Vikaas and Savi take that, because I'm not an expert on gold.
Yeah, neither am I. But I think what is universally accepted is that gold is a good hedge against inflation, and we really don't look at it as a strategic asset that we allocate capital to. Anyway, we only invest in equities. But I don't think there's a right number, but you could have some diversification in the form of some small allocation to gold, I guess.
Vikas, what's your take on gold? We have seen that, there has been a lot of product innovation with regards to gold as well. Instead of just as a yellow metal that you can hold, it has become a financial tool with the rise in interest with SGBs as well, sovereign gold bonds. What are your thoughts on that?
So I think in terms of gold as an asset class, especially culturally, it is not whether you should hold gold, but how much gold you should hold, which is usually the question. I think people go overboard in terms of an asset class, and I'm talking about all physical assets, whether it's real estate or whether it is gold. You will typically find a disproportionate allocation in the Indian investors' portfolio, which I think is changing right now. So to answer the two parts to your question, one part was Pravin's question in terms of how much gold should one hold. Depends not just on the age, but I think it depends on your goals. It depends on your disposable income. It depends on your savings. But to my mind, in a country like India, if you have more than 5% gold in your portfolio, I think you will not do enough justice at whatever stage you are in terms of the cycle. And in terms of what form of gold to hold, I frequently advise people to hold gold ETFs. They're easier to hold, they're easier to liquidate, they're easier to monitor. So I think that's pretty much what my answer is.
All right, sure. Also, since 2017, we have seen that the small cap and mid cap, they were not performing, but in this rally, they are back, right? What are your thoughts on the mid cap and small cap sector? Is it different than what we saw back in 2017? What has changed since then? Yeah, Vikas, you go ahead first.
Yeah, so every time such a question comes about, I'm mindful of the fact that it might be treated as something which was very prescient in terms of an answer, or it could be famous last words. So with with that sort of caveat, I think there has been a difference in terms of the mid cap rally which one saw from 2014 to 2017, 18, and of course the 18 bloodbath which happened. Four points which come to my mind immediately. I think one is that financials are in better shape. Whether it is financials in terms of the lending entities or the financial entities, the financial institutions, or you're talking about companies themselves, financials are in better shape. Especially in terms of banks, I think the tier one ratio, the equity part of it, it's pretty significantly stronger at this point of time than what it was in 2017. The third thing is that inflation was missing earlier. Inflation is coming back, and a moderate amount of inflation is usually welcome, in an economy, especially growing economy like ours. And last but not the least, I think in the overall context, if you look at utilization rates in terms of corporates, I think in 2017, and Nitin and Savi may correct me if I'm wrong, it was around 70 odd percent, and it has probably come up to around 74, 75% at a mean level. So I think if you look at all of this, and I'm not factoring in the macroeconomic factors, I mean, the system has been cleaned up, so my limited point here is that mid caps and small caps are in far better shape. The smaller companies are in far better shape. Mind you, some of these companies are small just by market cap. They're not small in terms of market share. They have some significant advantages in terms of their overall business models. So, and of course, if you have strong quality managements, money is starting to flow there. So to my mind, I think the mid cap and small cap story is just about beginning now. It had, a sort of a wave in the initial stages. It corrected itself. There were certain factors which did do it under, but I think it is back much stronger than before. Even if you look at in terms of the valuations, the strong quality stocks, if you look at the benchmark, you will tend to argue, and I think Pravin will be the first one to tell me that the index, what it was then and what it is now, it's almost at the same level. But if you look at strong quality stocks, we did an analysis in terms of our own portfolios, in terms of quality stocks, the way we understand them vis-a-vis the benchmark, and we have realized that when the markets went down, they were, they went down lesser, and when the markets picked up, they actually went up faster. So there is a growing appreciation which is coming in from strong small and mid cap companies.
Sure. Savi, what are your thoughts on small and mid cap? Has things changed? Like we saw that, post 2017, a lot of the fall in the segment was due to major corporate governance issues in many firms. Do you think that has changed, improved in the last couple of years?
See, I think in any bull market, there are those, crooks, for the lack of a better word, who will take advantage of the exuberance that is there in the market. So that you will always see. I don't think it is a surprise that such kind of companies go up and down in bull and bear markets. But overall, see, on an overall level, I definitely feel there is some bit of exuberance in the valuations. But we are a concentrated fund, and we invest in a maximum of 15 companies. We are still able to find those 10-12 ideas that we want to invest our monies in. But I would not say that the market in general is cheap, especially in the small and mid, or even in the large cap side of things. So yeah, I mean, that's how we feel about the valuations.
Like all three of you mentioned that one can still find a few opportunities in the small and mid cap space. What are some of the sectors where you can find things which are still not very reasonably costly, can still look attractive at current valuations as well?
One sector where we're still finding some kind of value is financials. I think that is where there is still some value available, and we have a large exposure to the sector. It is also a large part of the index itself. So that is at least one place where we are still finding value. And I think one general theme where we do invest, that we were earlier discussing about how you will always find quality expensive. I have a slight disagreement there, in the sense that often at times there are some really good companies, good quality companies going through some temporary phase of pain. Either the industry is underperforming, and it's not a structural problem, it is a temporary problem. And I'll just give you maybe an example of one of our portfolio stocks. So we have this investment in a company called ICICI Prudential Life Insurance. Now it's not a small cap, or it's not a mid cap even, you could call it a large cap, but it's a sector that is doing well. And if you look at the largest player right now, which is HDFC Life, it did really, really well. But at 6 months back, ICICI Prudential was available at less than half the valuation of HDFC Life. Now, the question that we asked ourselves was whether there is something permanently, wrong with this company. Are these issues that the company is going through, is that not solvable? And the answer to that was that this is just temporary, and we got to invest at a really attractive valuation. So even now, it is not very expensive, but there are often times when several good companies, you may have a microfinance company, because of COVID, obviously all of them have fallen by quite a bit. But if you can find a really good company which which has done well across cycles, then you could even now invest at a good valuation. So a concentrated investor like us, we often follow this strategy where certain good quality companies, really good quality companies, but are going through some temporary phase of pain, and hence we are able to invest at good valuations.
Sure. Vikaas, would you like to follow up? Yeah.
Yeah, I think I would agree with Savi. I think that is what I mentioned about rolling up your sleeves and looking at high quality management. And these are stories which are abound everywhere. I mean, for every stock which Savi mentioned, I think there will be another stock which somebody else can mention. It's just that you have to be aware that if a good quality management is available at a less than premium or a less than quality price, you should be able to pick it up. Yeah. But specifically on your question, when you talked about growth sectors, the pockets of growth, if you will, I think there are 3 or 4 which are clearly emerging. And when you're talking about a country like ours, which is now probably the tipping point in terms of growth over the next 5-10 years, obviously, I think I'm just going to second one sector which Savi mentioned, which is in terms of BFSI. I think India stopped moving on agrarian economy as an agrarian economy long time ago. I think credit moves the economy, monsoon doesn't anymore. So I think BFSI is going to be a big winner in the next few quarters, the next few years. I think consumption, discretionary consumption is going to be a big one. Well, people talk about discretionary consumption in terms of auto, white goods. I just like to sneak in a few more in terms of travel and maybe insurance. I think as people's incomes are going up, the discretionary spend, the texture of the discretionary spend is changing. And that is something which is very, very exciting. I was hoping Nitin would speak before me because I think he mentioned that capital goods is something which we are very excited about. I think that has the potential to do very, very well. And I think in terms of the digitization and automation which is happening in the economy, it's not just digitization and automation in terms of the IT sector, but I think any company which is using the internet, for lack of a better word, in terms of its growth model, they've got some very exciting prospects. We may or may not have them in our portfolio, but some of the stocks which excite me are the gaming stocks. Are stocks like IRCTC, which are using the internet to grow. We're looking at the Zomatos of the world and a variety of other companies which are coming in. This is a completely different segment which is coming to the markets, and I think there seems to be a lot of growth potential.
Sure. Yeah, Nitin.
Rather than actually looking at sectors, I would say one should look at the next decade as perhaps themes, because we've seen that not all stocks in a pharma sector or all stocks in consumption sector actually behave in a similar manner. So one of the things that has started, I think, about 4 or 5 years back, we are living through that trend, is the formalization of our country's industries. But when I hear about stories about multiple sectors can get formalized, I think the 2 very large sectors in India, or for that matter in any economy, are credit and real estate. And you are seeing a very massive shift over there, where a small entrepreneur can now get equity or debt because they are able to create a digital footprint for multiple initiatives, either the government or the telecom has actually brought into it. So hence, formalization of credit and how that impacts many small and medium enterprises or many small and medium businesses. I think this will be one of the biggest themes in the next decade or perhaps decade. That's number one. The second theme could be, which we've been thinking for the last 4 or 5 years, that one of India's big bull markets would be not the residential asset class, but most likely the residential real estate sector or commercial real estate sector. Why? Because this was governed by capital, which was perhaps unorganized. And the capital is becoming a lot more organized in that phase. Hence, you should see real estate getting a lot more formalized. They're very two large industries. And they have multi-step and multitude second and third order degree impacts on multiple industries that will come. So I think when investors are thinking about their portfolios, they should think about that. It could be even microfinance companies, as Savi was mentioning, because many smaller businesses will get that finance, etc. That's number two. I think number three is the entire health. In India, what we saw in the 90s or in the 2000s was a massive change in house ownership because of the professionalization. House prices were going up, but the formal incomes were coming in, which is helping them take loans, which was mean, the savings that you will generate in the future, you could take loan against that. Healthcare is becoming very expensive in India. So what you could see over the next 5 years, 10 years, 15 years, healthcare penetration, the pay mix moving away from more unorganized borrowing or perhaps not able to pay to more government or to more employee or to more going through similar sort of a health insurance plans, the company, something like Savi mentioned, and the entire ecosystem around it. So that's the third theme. And the fourth theme is what we are seeing in India in the financial markets, participation of investors into the stock market, but at the same point in time, their openness to adopt, ability to understand assets and invest in financial assets rather than just gold. Hence, four themes about finance formalization, real estate formalization, healthcare, and the fourth one is the savings. So if you can think about this, how it is going to create opportunities, find good companies, opportunities will be larger, and companies can become multiple sizes what they are today.
Nitin, I would like to quickly ask another question on what you said. You said that real estate is going to get formalized a lot, right? And you also mentioned that we have more evolved financial products in the market as well now. Now, in the real estate segment, we have seen the rise of real estate investment trusts as well, REITs, correct? A financial instrument that has been there in the US since the 60s, but recently got introduced in India. So, can investors look at that emerging theme as well as a way to get exposure in the real estate sector rather than just investing in physical real estate for that matter or real estate company stocks?
Generally, REITs listed in India are a play on the commercial real estate properties. They're giving you a very good yield anywhere between, let's say, between 8.5%, 10% also. Reasonably good amount of dividend distribution flow that happens every year. Any investor who wants to have relatively higher yield than GSEC, wants regular liquidity to inflow, yes, they should look at REITs. That could be a good asset to own in your portfolio. We cover a few names and we are advising investors that they should be building a basket of the listed assets. And I think all of these three companies are run by very good asset managers. And perhaps as India goes out and builds more grade A real estate assets, you would have an option of growth as well as dividend distribution for the investor. Could be a good asset allocation to own within the portfolio of an individual or a high net worth.
Sure. All right. Savi mentioned a very interesting point that there are many good businesses that are going through a tough time right now, and because of COVID, we have seen sectors who have struggled, right? So when picking in such kind of sectors, what are some of the metrics that investors can look at? Savi, would you like to go first?
Sure. I think, the first important question that you need to answer is whether this disruption is temporary or structural. I think that is the most important question. You can have, paper companies, print paper companies available at low single-digit multiple. You can have, TV distribution companies available at very cheap valuations. But the answer that you need to know is whether this is due to a structural reason or due to a temporary reason. I think that is the most important. You can't quantify it in the form of a metric, but I think qualitatively you need to assess that. And if you can find businesses which are going through only now, for example, due to a lockdown, certain businesses obviously will not do well. Something like, say, a financial company which is dependent on physical collection from their customers. It is physically not possible to collect money in during a lockdown, and therefore there will be elevated NPAs, and not necessarily credit cost, but at least accounting NPAs will rise. And because of that, some of these stocks may go down significantly. Now, if you take a 3 to 5 year view and you believe that it is very unlikely that we will remain in a lockdown for 5 years, and at some point the collections will come back, at some point the growth will come back, the opportunity is there, so then you can obviously go ahead and invest. Obviously you need to have that kind of a time horizon. This is not a 1 year, 2 year play. I think minimum 5 year is something that you should look at when you invest in such companies, because you don't know the exact point at which the prospects will turn, right? We had one lockdown, then we had a 4-month break, we had another lockdown. Who knows? We might have another lockdown. So so in the near term, it is not possible to say when exactly the business prospects will improve. But if you have a long horizon, you can confidently say that this will do well. So I think this is the most important factor. You can't quantify it in the form of a metric. But obviously, the one metric that can work on your advantage is cheaper valuation. So if you have cheap valuations, you have a margin of safety on the price. Even if there is further deterioration of the prospects in the near term, you are protected to the extent of the valuations, because the valuations have a margin of safety built into them.
Sure, makes sense. Yeah. Vikas, why don't you take the next question first? Do you think retail investor, the behavior has changed this time around? And is the new crop more mature than the ones before?
But I think if you look at the retail investor or the average investor, as I'd like to call it, there is a lot more information available than there was ever before. And primarily due to the lockdown, I think the propensity of people to learn more from a point of view to earn more, I think has led to an explosion in terms of maturity levels. Now, somebody might always come back and tell you, listen, somebody picked up a penny stock and he lost money, or somebody did something stupid and lost money. But by and large, if you look at a trend, I think the retail investors have understood quite a bit in terms of the risk reward ratio of how the markets evaluate. So even if they're into trading, they know exactly what to do, when to cut their losses. If they're into investing, they start off with mutual funds. In fact, a lot more people are moving away from mutual funds to guided advisory portfolios. The alternates industry, the AIF and PMS industry has seen an influx, a huge influx of savvy HNI money coming in. So I'm saying if you look at the entire cycle, the way things are moving, information flow is now becoming a constant. It is the propensity of the retail investor to absorb that and work accordingly. Having said that, I think one of the biggest triggers for the maturity of the retail investor has not been now, but a few years earlier. And I think I was on the board of Amphi at that point of time when SEBI said that 2 basis points out of a mutual fund's AUM has to be spent on investor education. And if you see, mutual fund Sahi as a campaign actually started off then, and it has had a ripple effect across every sort of nuanced equity product that you offer. People now understand equity, people now understand risk, people now understand about long-term investing. So I think, again, I will come back to the point of view that I really don't agree with the generalized perception that retail is again going to get trapped and all of that. Of course, there will be some people, but there are a lot of smart investors out there, and they're getting smarter by the day. They're learning from the experiences, they're learning from the information. And I think this is a very healthy sign for the economy.
Sure. Nitin, what are your thoughts? Are the retail investors better placed this time?
So now if you look at our country in the last 2 decades or so, we're generally seeing the level of education and the wealth creation by a lot of professionals, first generation entrepreneurs, or even the third generation entrepreneurs who started the business in the 1950s. A very different class of people are creating wealth in India. And hence, when they were how they've approached their careers and how they've approached their businesses, has a rub-off effect on how do they allocate money. In the 90s, a median individual in India at 8 out of 10 people would be investing mostly in real estate, because the money was of that kind, perhaps black available so much that you could invest in real estate. Today, you are seeing family offices which have generated a lot of wealth or dividend income. So they are coming to the market. So hence, I would say there is a mix of both kind of investors, the informed, the smart, and the possibly who have just recently participated in the momentum. It will be very difficult to say that, on a whole, this bunch is better than the bunch of 2007 and was better than 99, 2000. I would say that will be unfair to say. Population-wise, we are very different, but mistakes will be getting created in any pocket and every pocket right now. When I see today investors buying companies which were fly-by-night companies of the 2000s in the technology boom, and they're coming back for, again, investor interest, or certain music companies of 99, 2000, becoming the tip of the market. So, and they're just bouncing. That worries sometimes. Say, is really the retail investor that smarter? But I would want to believe it is. But these are just signals that I have, or signs. I don't know what they are.
But Nitin, let's just look at these two funds that got launched. One was the ICICI Balance Advantage Fund, which collected around 11,000 crore. SBI launched a fund very recently. It's still on, maybe. They have collected more than 13,000 odd crore through balance funds. And it is kind of like, in a market which is scaling very high, the takers for balance funds have increased. Of course, like there's a lot of work. It's a push product. The funds have worked hard. How do you interpret this in from the point of retail investors itself? Like, this entire subscription. This is a question to all of you guys. Like, I find it very interesting that people are kind of becoming relatively risk savvy. I mean, savvy, Vikaas, of course, Nitin, you are there. Like, can you kind of throw some light on these aspects, because these are numbers, real numbers out there.
Vikaas, Savi, why don't you start with this?
Yeah. I mean, see, it's good that retail investors are waking up to the various options that they have, and see, what we need to see is whether a lot of these investors have come for the first time. If you look at the number of demat accounts that have opened in the last 2 years, the number has gone up by almost 75-80%, and most of these are retail investors who have probably come for the first time either to invest in an IPO or do some kind of direct investing. Now we don't have information as to what exactly how exactly will they behave whenever there is a downturn or a fall. But history always rhymes, and if you go by what has happened in the past, there will be people who will be trapped. Obviously, there's more information now, so the information arbitrage, that was there earlier when promoters could fool retail investors because there was very little information available. Any retail investor who has the wherewithal or the intention to do some kind of research on a company, on a fund, on a promoter, if a basic Google search can or a Twitter search can show him what is good and what is bad. So at least that plethora of information is available online, but how they use it to their benefit is a question mark. So I don't think there's a definitive answer as to whether they become more mature. That only time will tell.
In terms of shareholding pattern, you see the retail share increasing, especially in small caps?
Yeah, not necessarily small caps, even shady companies where it is very clear that the equity will go to zero because they are going into NCLT, or it is very clear. There you will always see a significant increase in retail shareholding. So that is not a surprise. That has always been the case, and this time around also it is the case. So these kind of metrics at least do not tell you that they have definitely become more mature.
I just want to give a different perspective. I think this is looking at things from the rear view window. If you look at things going forward, I can just give you 3 points. I've been associated with the mutual fund industry for quite some time, and I think most of the time it doesn't get the credit it deserves. So 3 points, I think, especially the two names that you mentioned. I think number one, these are by entities which have proven their worth over a period of time. I would have been very surprised, and I would have tended to agree with Savi's point if it was a recent entrant, which would have collected money without sort of a track record. These entities have been around for 2.5 decades. Yes, of course, strong distribution system notwithstanding, I think the track record has been very good. Two is, I think, traditionally, this is a survey we had done a few years ago, which talked about 2 points. Point number one was that if an investor enters through a non-equity product, his stay in the industry is close to 11.5, 12 years. But if he enters through an equity product, and that usually happens at the peak of the market, he stays around 3.5 years before he gets disillusioned and he moves out, right? So the point here is that most of the money is coming through a balanced advantage fund. Okay, which I think is a very, very healthy sign, and again talks about the maturity of the investor. It is not like he has gone into a thematic fund or something like that. You are talking about a serious amount of thought which has gone in. I would like to believe that. FlexiCap, one can argue, but even if you look at the recent mutual fund statistics, 99.23% of equity subscription is from retail investors who are less than maybe 99.23, 97.23, if my memory serves me right. But it is through retail subscription. And from what I hear about the ICICI Proof FlexiCap collection, I think a bulk of the subscription has come in through SIPs. Again, which talks about how the whole pattern is changing. And I think the last thing again is the information and the investor awareness. You're talking about this whole campaign which has been going on about mutual fund SAI and all of that attention. Again, Pravin, I'd like to remind you that this is on the back of just a year and a half after a lot of negative publicity the mutual fund industry got. So I think times have changed. The investor is learning to distinguish between good and bad, hopefully. Last but not the least, this is an additional point. Where else will he go? There is a Tina factor also, and one can look back 3 years from now saying that the timing was wrong, etc., etc. But I would like to believe that with each success that the mutual fund industry or any industry gets, you're getting in more and more people exposed to equity and thereby understanding the vagaries of equity a lot more better. It's better to invest in a mutual fund rather than, what I think Savi mentioned a very significant point about shady companies and they're going to zero. It's better that an investor gets into a mutual fund and maybe there could be a couple of quarters of heartburn in case the market tanks or whatever, rather than getting into a company where you see no light at the end of the tunnel.
Yeah, in fact, one interesting point for SBI Balance Advantage Fund is like a huge amount is coming to them through tier 2 and tier 3 towns. So because since you have been in this business, how do you interpret that information?
It's very simple. It's democratization of information. Information is no longer at a premium.
But it's also a very hardcore push product also at the same time, right?
See, in this country, distribution is king. Okay, you talk about whatever product. You're talking about areas where you will not get drinking water, but you will get a bottle of Coke. Okay, so or you will get a Bisleri bottle. Right? So distribution is key, and I think we should not move away from that. If you're talking about push product and you're saying that distribution versus advisory, yes, I would tend to agree that advisory is more of a self-educatory pill. People are taking it and trying to understand the markets themselves without trying to pay their advisor, or some of the advisors need to be qualified more. One can have an extensive debate on that. But without distribution, this is a very complex country. And distribution can be offline distribution, online distribution, the way you want to look at it. So I don't see any reason why we should, frown upon the fact that it is a push product. It is a push product. Any product in this country, more often than not, is a push product.
So coming back to that one interesting thing you are saying about push products. Now, if you look at a lot of discount broking houses, how come they became so successful in our Indian markets? If Virudha is really the big guy out there, but there are various other guys who are out there who become very big. And I'm not talking about this bull market. We have seen them gathering market share from pretty established big players. So while we are talking about distribution, what do you think is happening out there? Like, do you think again it is democratization of information and more people finding it out that, hey, let me just go to the guy who is giving me the cheapest way to trade in the financial markets?
See, distribution to my mind is the conventional distribution definition is you get a fee, you pay a fee, and you push the product. Okay, when I say it is a push product, means that it has to reach the customer. We are a very complex country in terms of logistics, and internet has made it easier for a good product to reach the customer. And this is a good product which has reached the customer. The internet has aided that. While you might talk about the pricing part of it, which has been very attractive, and no two ways about that. But I think if it were not for the internet penetration and the bandwidth available across the country, I mean, the bandwidth explosion which has happened across the country, an industry like that would have taken a lot more time to take off. So from that point of view, distribution is bandwidth. It is not necessarily a distributor talking about zero-based.
Sure. Nitin, your thoughts?
So on the question that Pravin perhaps asked was in terms of Zerodha, how they've become successful. Uh, I can only say perhaps to the point that Vikaas said, there is a distribution, but also there is an investor or perhaps a consumer psychology. You're giving them something for free, and though it is actually not free, but if you actually tell people that it is for free, and what happens? I think number one. Number two is friction. I think the cell phone, the mobile, the kind of technology perhaps that Zerodha invested in has actually reduced a lot of friction of investing a few thousand rupees, or perhaps not getting a very easy, let's say, pricing. We have seen that how many years back how internet investing actually changed the whole game, and perhaps mobile penetration was much faster, much higher at any point in time in our country compared to an internet from desktop or let's say a laptop. And hence, what you're seeing right now is companies like Zerodha, which are probably a few months or years ahead, which created a lot of difference as last 1 year, 1.5 year, people are adopting to this particular. I think I would actually go to the human psychology, which Pravin you keep on talking about multiple times, is actually the pricing of the product, which appears free, reducing the friction to trade in the market. And number three is continued connectivity or awareness of the price of the portfolio on your tips, on your hand. So, those three things sort of create a lot of a continuous engagement, and continuous engagement creates activity. And perhaps that's where Zerodha. And we've seen that multiple other companies. There's another leading broker called Angel. They've actually revamped themselves. They've also gained and they've come back. So I think people are learning from the leaders like Zerodha, and perhaps this is what we are seeing in the world also. And hence, the traditional brokers were perhaps not thinking on these lines. And hence, they saw themselves lose market share to people who were preparing for the tomorrow when suddenly a positive or a negative accident. So that will be my take on why there was a market share gain shift between the traditional brokers to a online one.
Sure, Nitin. Those are some good thoughts from all of our panelists. Let's move on to the Q&A session. So we had received some questions from our members when they registered, and we are getting quite a few questions from our listeners as well, right? So the first question is from Karthik. He's asking, what are some of the trends, themes that you expect to do well over the next 3 to 4 years? He's also asking the panelists' views on the valuations of some tech stocks that are trading at current valuations, and some of the recent tech IPOs as well, like Zomato. We have Paytm lined up as well now, right? So yeah, Nitin, would you like to start?
I think I did share my views on the 3 or 4 themes
Hmm.
earlier in the conversation that I would say investors should think about in the related or space, which was formalization of credit, formalization of real estate, whether it is buying as a consumer or commercial real estate. Third thing would be the entire healthcare space, how healthcare penetration and insurance and platforms would come through. And that was number three. So the fourth theme was about savings. So hence, these are the 4 themes that investors should be looking at for the next 3 to 4 years, perhaps even a decade. So that would be my 4 themes. Siddharth, perhaps I'll take Savi and Vikaas to reply to this before taking this.
Sure. Yeah, Savi, would you like to go first?
Yeah, I mean, I think I would agree with Nitin on some of the themes. Financialization of savings, definitely a big theme. Now, how do you play it is the question, and whether you get an opportunity to play it, because some of these stocks or companies are trading at very exorbitant valuations. So while the theme is very clear, but the ability to play the theme is not very clear, and that is the problem we often struggle with. Tech obviously is a big theme. Now, whether you can invest in a Zomato at a 1 lakh crore market cap, or whether you can invest in some of these other tech stocks that have come through. Now, as value investors, we struggle to value these kind of companies. It becomes very difficult because obviously they are not making profits at the moment, and it is very difficult to project what will happen 3 years, 5 years down the line. And so it is not easy to say whether something is cheap or something expensive. And I think this is not a problem that we are uniquely struggling with. I think even if you look at very renowned investors like Buffett and some of these guys, they missed the tech bus, at that point. And at that point, some of these companies are not as expensive as what they are today. So, I kind of agree. But I think one theme that Nitin mentioned, where we are still finding some value, is credit growth. Economy cannot grow without credit growth, and that is inevitable. So you can't be assuming that other sectors will do well while the credit growth will remain lackluster, which it is currently. If you believe the growth is there, then there are some really good companies out there where we are still seeing value, some real value, and that is where a large allocation is for our portfolio. Then we have certain very esoteric mini themes like holding companies. We have few holding companies in our portfolio. Again, these are traditional value bets. The underlying companies are very good companies, but they are very expensive and we don't want to own them directly. Whereas there's a discount of almost 75-80% in the whole course. And earlier there was a leakage in the form of DDT. That has gone away after the changes in tax a year or 2 years back. So there is absolutely no leakage in the form of dividends, and because of that, we believe such kind of a high discount is not merited. So we are invested in a few holding companies. So these are some some large either major themes, or there are some mini themes where we are deploying our capital.
Sure. Vikas, what are your thoughts? What are some of the themes and trends that you expect to do well in the next 3 to 4 years?
Yeah, I think I broadly agree with my co-panelists. The only thing is that I would just want to add that if you look at what will do well in the next 10 years and you roll it back and see what is going to be the growth in the next 3 to 4 years, I think that will be better rather than organically looking at 3 to 4 and then seeing how it will pan out over the next 10 years. So if I have to look at the next 10 years, I think the growth is probably just starting. And there are multiple triggers. At a macro level, you are seeing China, gradually falling out of favor with global institutions. Most of them will start coming to India in the edtech sector, in the fintech sector. I think that should be very positive for the country. And there will be a lot more business models which will come out there. But from the conventional ones, I think two of them which come to my mind immediately. And we are, I mean, as a growth, as an investor in company which looks at quality at reasonable price, we look at very high quality managements, and we have our own way of looking at things. But from a sectoral point of view, two sectors which excite me. One is insurance. I think insurance is, you're going to see, this is the beginning of the beginning. Some of the world's largest companies, I mean, before they broke up in 2008, were insurance companies. And I think it's a model which is now starting to gain favor here. The other is, I think globally, one of the things governments have realized is that their healthcare system has completely been tested, and it has not, stood the test of time. So a lot of countries are going to invest in healthcare. In India, there will be direct impact in terms of hospitals, in terms of pathological labs, in terms of pharmaceutical companies. But even at a global level, when things start taking off, you will find the ripple effect happening in India through things like CRAMS, CDMO CRAMS and the like. I think these are huge opportunities. So from an investing point of view, while we will be very careful about what valuations we get in, I think there will be a time and a place where we'll have to look at the broader trend, the larger perspective, and say, okay, even if it is slightly expensive now, but it's a high quality management, it fulfills the parameters. They've got an inbuilt model called equal, which has stood the test of time. So, if it fits into those parameters, it's okay. We will buy that stock because we believe in the larger trend which is happening.
Sure. All right. Vikas, I think you'll like the next question because you must have had a lot of discussion with Praveen on this one. So Raghu is asking, is momentum-based investing a time-tested option?
I've had discussions because I've been wanting to learn about that from Praveen. And I think Praveen should answer that.
Praveen, why did you take that question?
It is a time tested option. Of course, it's like it's been there for the longest time. So problem is that in India we are looking at momentum as in a very crude way, satta bazari, or in a way like something that is trending mein usme jaake usme you just kind of make money more out of luck. But there is a big strategy out there. Yeah? Like it's a fairly data driven strategy, and you're seeing funds like Renaissance and so many of them have used this strategy. And if you look at the strategy for the last 10 years, momentum has done really well. And especially when compared to value. Going forward, what will work? Now it looks like the value is coming back. So it is a time-tested strategy. And I always feel that, when one strategy is trending, you should flirt with the other one. So while momentum was completely trending, had you started taking a little bit of exposure to value, you would have made a lot of money. For example, the value index was last year, like you had all the commodities and metals were part of the value index, now which incidentally are part of the momentum index. So that is the point to be made, that you don't need to completely go with one strategy 100%. A little bit of exposure to something that you don't believe in, you should just have it for the heck of it. In my case, right now, I would just have a little bit of value as compared to momentum, and it looks like value will come back. But let us see. It's always good to have some kind of exposure in things that you don't believe in. That's how I look at it.
Sure. Savi, would you like to chime in? Because, people have all compared value and momentum a lot over the last 1 decade, and you are sort of a classic value investor yourself, right? What are your thoughts?
Yeah, I mean, for someone like me, it would be blasphemous to say that we believe in momentum-based strategies. But I think to each one its own. But my advice would be, I see a lot of people do it on their own. So DIY on momentum is something that I would ask retail investors to completely avoid. There might be some, institutional frameworks or setups which may have some kind of track record. Maybe if you want to take exposure to this particular strategy, you're better off giving your money to them. But because I'm sure they apply some kind of filters in the form of corporate governance, fraud, etc., before they invest in any momentum stock, which a retail investor might not be able to. There is complete price action based allocation to stocks, which a lot of it I see around. So although I may not believe in this strategy, but my advice would be, if someone wants to take exposure, it is better off taking it through some kind of institutional setup.
Sure.
So,
Yeah, Praveen.
so there is one fund out there that is basically based on the momentum index of the NSE Nifty. It's called UTI Momentum Fund, which is basically follows the NSE Nifty Momentum Index, and it's in the top 200. So it just looks at the top 200 stocks and does it filters. So like Savi said, that it's something that you don't want to try on your own. Then there is at least one product in the institutional space out there.
I think there are a lot of small cases, around,
Yeah,
which also, have some of these strategies. So I think there are various options available now for investors. I think there's
but
some
again, Savi, small cases are also not that transparent, and
Yeah,
there are a lot of issues out there which we don't want to go out in this discussion at this point in time.
Yeah, agree. Yeah, I mean, obviously you need to do your homework on the fund manager. There are some notable fund managers on small cases as well, who otherwise are running PMS and AIFs. So you obviously need to do your homework. If you're not doing your homework on stocks, at least fund managers is something that you need to do your work on before you allocate money to anyone.
Sure. Nitin, why don't you take this next question? It's from Girish. He's asking, is national income per capita really increased? He is reading many articles mentioning that poverty levels have increased since the start of the pandemic. Your perspectives. So this is a classical question where people feel there's a disconnect between the state of the economy and the markets, right? So do you think the situation on ground is still very dire, or eventually that is something which will catch up with the market as well?
I'm no economist, and I don't think so. Our country actually offers data to the last and the recent most. We are still working on the census of 2011. We're waiting for the 2021 census. So hence, it will be whatever I will say will be just anecdotes, and sometimes anecdotes are not data.
Yeah.
So hence, on that particular aspect, clearly there appears to be some sort of a pressure in a large amount of the urban poor in terms of their incomes. I can't say the rural poor, I can't say the urban rich household, but definitely there appears to be a pressure on the urban poor or urban lower income group also, because many of them are used to earnings their salary from providing support services in offices, working in mobility, or possibly even houses and residential, or even restaurants for that matter. And the kind of jobs that are getting created are the delivery jobs in the country, or for that matter, the back end jobs in the country, which may not be that high paying in terms of what perhaps on these service jobs they're losing. So I think there is more wealth getting created in the country, but the wealth is getting created at people who are money is at work. Income wise, GDP perhaps may not be at the right stage where it left off. There is a feeling that urban poor is perhaps at a loss on the income, whereas the urban rich person may be actually creating more savings right now. We've written a few things on this, but I think it's very early days to conclusively say anything on this. We'll have to wait for as the data comes up.
Sure. Vikas, what are your thoughts?
It's interesting. This question is very interesting. It's more of a socialistic question than an economic question, I believe. And I completely agree with Nitin's point of view. I think at this point of time, we are probably too close to the mountain to see how big it is. We are looking at data points which are there or which are probably emanating. But the way I see it, if I look at it from a structural point of view, this has always been the case. The rich have got richer, the poor have got poorer, and probably in recent times when you're seeing, in social media, these sort of names coming up about wealth creation and all of that, that probably raises this thing in your mind that it is happening even more starkly. But there are two basic things which I believe will change things going forward. I'm not saying that the rich-poor gap will go down, but I'm saying the urban poor, as Nitin puts it, will probably be a little bit more at ease. One of the biggest expenses which the poor, whether it's rural or urban, have is on medical expenses. So the government's thrust in terms of free insurance and all of these dispensaries and medicines, etc., will actually lead to a lot of alleviation in terms of expenses at the poor level. The second thing is, I think more and more people are now realizing that if you don't start saving money, I'm not even getting into investing, I'm saying saving money, you are going to be having a problem, which is where while there you will keep finding those sporadic incidents of people putting in money in chit funds and getting lost everywhere. But there is an increasing amount of money which is now starting to go into savings accounts. I mean, there are compulsory savings accounts which are being opened. Digitization has happened. People are getting exposed to fixed deposits. People are getting exposed to SIPs. And I'm talking about SIPs of very, very small denomination. Now, you might come back and tell me a guy who's earning 5,000 rupees a month, through a gig job, how is he going to invest in an SIP? And I really don't have an answer to that. He has to first control his expenses, which is where, again, I'm talking about a structural trend. The government chipping in and taking care of most of the expenses which the poor do undertake. So it's a trend which has started evolving. 5 years down the line, 10 years down the line, I think we will have a slightly more nuanced and different answer as to how these measures have improved. But my sense, and I'm an optimist, is that things will only turn out for the better. And I don't want to look at the stock markets as a barometer for evaluating how the urban rich or how the urban poor and the rural poor are doing. I think there is structural stuff happening out there which is going to show its
Sure.
colors.
All right.
Yeah.
Savi, the next question is quite interesting as well. Unfortunately, the member hasn't mentioned the name, but the question is why pharmacy sector is on a downturn even though the COVID third wave is on our doorstep. So yeah, what's happening over there?
Yeah. Yeah, I mean, see, a large part of the Indian pharma sector is actually exposed to the US generic market or other regulated market generic markets. and which is a very highly competitive market, and there is significant amount of price erosion that is happening there, and it has only accelerated in the recent past, and that is leading to significant amount of I would say pain for a lot of the Indian pharma companies. So most of the largest Indian pharma companies are essentially at least have more than 50% of their business exposed to non-India domestic formulation market.
Sure.
Whereas a lot of there are very few pharma companies which have predominantly a domestic exposure. They seem to be doing well. Now, to the point on why it's not doing well despite COVID, I think that is not a clear-cut correlation that an increase in COVID incidents will result in higher revenue and profitability for pharma companies, because you know some of the value that will be captured by them because of COVID will also be lost out because of some other therapies where they are losing out sales. For example, acute and chronic are two basic segments which you can divide the Indian domestic formulation market into. So the acute business has done very badly over the last 1.5 years because people have not stepped out of their homes, or people are not going for small illnesses to their doctors, and because of that, that part of the market shrunk temporarily over the last 1.5 years. So my answer to the question to the question is that, one, there is no clear correlation that the pharma sector will do well because COVID incidence is increasing, because that is not necessarily true. And second, there are a lot of moving parts in every pharma business in India. They have exposure to various countries, various kinds of businesses. There is CRAMS, there is CDMO, there is plain vanilla, generic drugs that they make. And then there are obviously some high-end developmental work also that some of these companies are doing. So, so while some of these businesses may be doing well, some of the others may not be doing that well.
Sure. All right. So I'll ask the second last question for the day. Nitin and Vikaas, why don't you take this one? So Pratyush is asking, should we be worried about the euphoria in the chemical space? We have seen a lot of specialty chemical companies, especially, rally a lot in the last 1.5 years, right? So is the euphoria a cause of worry at this moment? Nitin, why don't you go first? Yeah.
So, I think the appreciation of the chemical companies in the last 3 or 4 years by the stock market, institutional investors, and the individual investors can be seen in the amount of the kind of valuation and the kind of listings that are happening in the recent 6 months or perhaps even 12 months. I think a number of those companies deserved good valuations because many of them are actually beneficiaries of more import substitution, then perhaps export substitution as the China plus one becomes reality.
Yeah,
it should become reality, may not become a very big thing, but it has to become very big thing because in India, we are a globally very small percentage. So hence, there is a euphoria, as you rightly use the word euphoria. There could be in certain pockets a huge amount of irrational euphoria also. I can't say that the same thing is applicable for each and every stock. There are very, very good quality companies. If the investor has a mindset of long-term ownership, some of these companies may be trading at very expensive traditional metrics of price to book or price to earning for 1 year forward, which is not the right way to look at companies, we would say. But some pockets will be expensive. So I can't give a definitive answer, Sidharth, that the euphoria is all right or all wrong.
Yeah.
There are some very good quality companies over there, but certain companies are definitely trading materially higher than their value.
Sure. Because what's your take? And also, if I could add, like, how do you spot some of these chemical companies which are not deserving of the valuations that they are? Are there any metrics, or is there any business aspect that investors can look at to find that out?
I think valuation is the clear one, and I think Savi will be able to probably delve a little bit deeper in terms of what exact nuances in which chemical companies do find them a little overvalued. But I'm just building on Nitin's point. I think as a country, I think some of the companies which are attracting those sort of valuations, chemistry is their forte. Okay? And I think probably the way printed circuit boards have been for Vietnam, it has been instrumental in changing the entire face of the country. I might just be exaggerating a bit, but I'm just saying chemical industry could do the same for us.
Okay.
Okay, it is probably a superpower at this point of time. There is a global recognition of the fact. The only thing which was not present here is scale, which I think most of these good companies have started factoring in. If you put a gun to my head and you talk to me about valuations, I would say that some of these companies which are attracting those valuations are because they are quite capable. They've demonstrated their track record, and they are now going in for capacity utilization. So in the short term, I think the markets are getting a little bit more ebullient than what they ought to be. But in the long term, these are the companies which are actually going to be representing this country in terms of the chemical industry going forward. To be more specific, Savi, would you like to share on the valuation part of it?
Sure.
Yeah, I mean, see, the way I look at it, the margins for a lot of these chemical companies have gone up significantly over the last 4 or 5 years. And in India, the odd thing is that when the margins go up, the multiples go up. So it is obviously resulted in significant, returns for investors. But the opposite also often happens. Margins go down and multiples go down. So that can result in a significant, significant losses for investors. So the risk reward, in my opinion, is not attractive. I'm not saying that the margins will go down, but some of these industries are cyclicals because, if you're making 30-35% kind of EBITDA margins and you really don't have a very big edge, there will be new capacity coming in, both domestic and, global. And that may result in decline in margins. And that will also be accompanied by decline in multiple. And that will result in significant drawdowns for investors. So you have to be really careful. If you're investing at the peak margins and peak multiples, you have to be sure that these will sustain. In my opinion, it's not that easy to say.
All right, sure.
In fact,
So the
just
last,
one point
yeah,
I think I
yeah.
missed out that I was talking more from a specialty chemicals point of view. I think
Yeah.
Savi brought out a point of basic chemicals, which is quite right. I'm talking more from a specialty chemicals point of view.
Sure. And the last question for the day is from Mukesh Tulani. He has asked 3 questions, but I'll take one of them, which is very interesting since we hit a new record high today. So Mukesh is saying he personally feels that the current rally is more liquidity driven than result driven. What are your views on that? And what could cause or trigger a crash if one has to come? So what are your thoughts, all three of you? Yeah. Vikas, why don't you go first? Yeah.
I'd like to go last on this.
Savi?
Yeah, I mean, it's took. I don't think anyone can call out the top and really say when things. I mean, for us, how we look at things is that irrespective of where the markets are, if we are able to find individual ideas available at reasonable valuations, we don't get into "कि अभी market गिरेगा and so I should wait." We deploy capital. So that is what we do. At the moment, we are able to deploy only 60 to 65% of incremental inflows that we are getting. So that should give you an idea of how easy or difficult it is for us to find, new ideas because of valuations. And yeah, I mean, that's my answer to the question.
Sure. Nitin, what could be the trigger?
So is this market liquidity driven? I think liquidity is a very important fact of life. It is a very important fundamental of markets. Like for economy or companies, there's earnings. Liquidity is an important factor. So it comes and it goes. Capital because performance creates its own momentum. Hence, perhaps liquidity is an outcome of performance also, and lack of alternatives, as we mentioned, because in India there were other investment avenues. Today, the amount of savings that the country is generating, there aren't many exciting avenues to invest. So, hence, number one. Number two, in terms of what could cause crash of the market, uh, you know, I don't remember properly that stock markets are lovely sentiment markets. They are not the real economy markets. Credit markets or some other places, the challenges brew. And those challenges then perhaps go out and create a challenge to the sentiment, which leads to a stock market going down. Market did not crash last year for some problem of its own. So the sentiment of the market post-COVID, of perhaps in 2007 and 8, the credit market freeze, possibly which led to the sentiment coming through. So in hindsight, we get to know what was the crash. Like nobody has till now been able to figure out what was the reason for the 1920s Great Depression crash in the US. Somebody says, somewhere in the Midwest or somewhere something was happening which led to the crash. Nobody has been able to pinpoint. Perhaps in this case also, whenever it will happen, but in 1, 2, 3 years, who knows when. take some years to figure out what led to that. To be telling it ahead of the time, it will be like it will be like just throwing darts in the air, not even on the wall. So
Sure.
please,
Yeah.
Vikas, your answer.
Because you're on the spot again. Closing statement.
No problem. No problem. So I think this is a very enriching discussion for me. I get to learn from the esteemed panelists. But some of the maxims are liquidity chases opportunity, and I think, and I'll probably come to that at the end. But liquidity actually exits on fear, and I think Nitin mentioned a very interesting point about crisis in the credit market. So usually you will find that the impact in the equity markets is the last. The crisis brews out somewhere else. It could be a credit crisis, it could be a geopolitical crisis, but the impact happens in the equity markets the last. And so if you have to just look at it from 2 points of view, if liquidity is going to be chasing opportunity, okay, where is the opportunity now? Okay, the opportunity is basically in emerging markets. Okay, I think global markets have had a stellar run over the last 10 years. And we are now going to see emerging markets. And in emerging markets, where do you see opportunities? You see it in China. To some extent, one might say that it is diluted, but definitely in countries like India, Vietnam, Bangladesh, that is where money will come in. The macroeconomic factors, at least in terms of the political will, is to change the macroeconomic factors to make things easier for people to start operating. My limited point here is that if liquidity chases opportunity, and the opportunity is in a country like India, one has to have no option but to stay invested. You can't call the top. I think Savi was absolutely right. You will find corrections. Last year there was no basis for a correction. Neither has there been a basis for the rise after that. So as an investor, the only choice is to stick to a place, a country where you see growth, and that is India. And you should just stop worrying about factors like liquidity. It will ebb, it will flow. But the next 10 years are definitely going to be for emerging markets, and you can actually go back and look at the last 50 years. It ebbs and flows. It goes between developing markets and developed markets. So the next 10 years are going to be amazing for emerging economies.
Sure, because so liquidity chases opportunities and nobody knows who rings the bell at the market top, right? So with that note, we'll conclude today's discussion. Thank you, Nitin, Vikas, and Savi. It was a pleasure having this talk with you. I would also like to thank our listeners for taking out the time to be here. Please stay tuned for more such talks.